Imagine a completely ordinary morning. Not a Monday, not a holiday, just a random weekday. You wake up, grab your phone, and scroll through the usual things. Messages, weather, maybe social media. And out of habit, not expectation, you open your investment app. Then you pause. Yesterday, your portfolio went up $417. You replay the previous day in your head. 8 hours of work, meetings, tasks, stress. After taxes, that full day of effort earned you about $320. And that's when it hits you. Your money made more than you did. Not because of luck, not because of a one-time spike, but because something fundamental is shifting. You're not rich, you're not quitting your job tomorrow, but for the first time, your income is no longer coming from a single source, your time. The balance of power has started to change. Most people will work their entire lives without ever experiencing this realization or even knowing it exists, and that's tragic, because once you understand it, you can't unsee it. This moment has a name. It's called the financial crossover. My name is Marcus, and I spend an unreasonable amount of time thinking about the invisible milestones that separate financial dependence from financial autonomy. If you feel like you're running faster every year just to stay in place, if freedom matters more to you than vague financial motivation, make sure you're subscribed. Because today, we're not talking about budgeting apps, side hustles, or skipping lattes. We're talking about the exact, calculable moment when money stops controlling your life and starts working for it. The two numbers that control your life. Whether you realize it or not, your entire financial existence revolves around two moving numbers. The first number is obvious, your expenses, what it costs you to live. Housing, food, transportation, insurance, entertainment, subscriptions, everything. For many people, this number sits between $4,000 and $6,000 per month. Yours might be higher or lower. The exact amount isn't important yet. The second number is quieter, slower, and often ignored. Your investment income. This is the money your money makes without your direct effort. Dividends, interest, capital appreciation. Early on, this number is almost insulting, a few dollars a month, something you barely notice, something that feels pointless. And because it feels pointless, most people give up before it matters. But here's the key insight most people never learn. These two numbers are moving in opposite directions if you're intentional. Expenses can be reduced. Investment income compounds. Slowly at first, then faster, then suddenly. At some point, the second number overtakes the first. That intersection is the financial crossover. It's the moment your investments can fully pay for your life. Not luxury, not excess, just freedom. Work becomes optional. Why this isn't motivation, it's mathematics. This idea isn't philosophy, it's arithmetic. Let's put real numbers on it. Assume your lifestyle costs $48,000 per year. Using a conservative withdrawal guideline of 4%, a rate designed to survive decades of market history, you would need approximately $1.2 million invested to support that lifestyle indefinitely. That's not a random figure. It's simply annual expenses times 25. That number is your crossover target. Not retirement, not being rich, independence. At this point, most people shut down mentally. 1.2 million? I'll never get there. But that reaction misses the most important part. The crossover point is not fixed. It's a function of behavior. What slow progress actually looks like. Let's walk through a realistic example. You're 30 years old. You earn $60,000 per year. You invest $500 per month. Your average annual return is 8%, below long-term market averages. Nothing extreme. After 10 years, you've built around $90,000. Your portfolio might generate $300 per month in sustainable income. That barely makes a dent in your expenses. After 20 years, you're roughly $275,000. Now you're generating close to $900 per month. Still not freedom, but something has changed. The curve is steepening. After 30 years, your portfolio approaches $670,000. Your investments now produce over $2,000 per month. You're more than halfway there. At this pace, you reach the crossover near traditional retirement age. And most people stop here and say, so what's the big deal? Here's the deal. That example assumes you never adjust your life. The lever almost everyone ignores. The crossover point moves when either side of the equation changes. Increase investments equals faster growth. Reduce expenses equals smaller target. Most people obsess over returns while ignoring expenses, but expenses are leverage. If your monthly expenses drop from $4,000 to $3,000, your annual cost falls to $36,000. Your crossover target drops from $1.2 million to $900,000. You didn't earn more money. You erased $300,000 from the finish line. That alone can remove years from your timeline. Now add higher contributions. Instead of investing $500 per month, you invest $1,000. At 8% over 25 years, you approach $860,000. Combine that with lower expenses, and suddenly you reach independence around age 55 instead of age 65. You didn't hustle harder, you designed better. What happens when you get aggressive? Now imagine you go further. You reduce housing costs through roommates or house hacking. You move to a lower cost of living area. You eliminate lifestyle inflation. Your monthly expenses fall to $2,000. Your annual cost is $24,000. Your crossover target is $600,000. At $1,000 per month invested, you reach that in under 20 years. Independence in your late 40s. Earlier if your income grows. This is why the crossover isn't fantasy, it's a controllable outcome. The psychological shift nobody talks about. Something strange happens as your portfolio grows. Early on, investing feels like sacrifice. Every dollar invested is a dollar you can't enjoy today. The progress feels invisible. Your portfolio goes up 20, then down 40. It feels pointless. But there's a threshold, often somewhere between $50,000 and $100,000, where everything changes. Your money starts to feel real. A 2% gain isn't lunch money anymore. It's thousands of dollars. You begin to feel compound growth. Your money isn't static. It's working. And your relationship with work begins to change long before the crossover. The freedom gradient. Financial independence isn't binary. It's not trapped or free. It's a gradient. When your investments generate $500 per month, your car payment is covered. At $1,000, groceries and utilities disappear. At $2,000, most non-housing expenses are handled. Each step gives you more leverage, more confidence, more ability to say no. You don't need to wait for the crossover to feel freedom. It arrives in layers. The quiet superpower, coasting. There's another milestone most people never calculate. The moment when, even if you stop investing, your current portfolio will grow on its own to reach your crossover by a certain age. This is often called coast mode. For example, you're 30 years old. You want $1.2 million by age 60. At 8% growth, you need roughly $150,000 today. At that point, your future independence is mathematically locked in. You can work less, change careers, take risks, not because you're rich, but because time is on your side. What about crashes, inflation, and risk? Yes, markets crash. They always have. The average bear market happens every few years and drops around 30%.
This is normal, and it's already included in long-term market averages. During the accumulation phase, crashes help disciplined investors. You're buying ownership cheaper. Inflation? Accounted for. The real risk isn't volatility. The real risk is never owning enough assets to stop selling your time. What you should actually do. Here's how to apply this. Track your real monthly expenses. Multiply annual expenses by 25. Subtract your current investments. Calculate how long the gap takes to close. Ask how to accelerate it. Every $1,000 invested produces roughly $40 per year forever. Every $100 cut from monthly expenses removes $30,000 from your target. This is leverage most people never use.
The final reframe. Every purchase has two prices: the money you spend and the time you give up later. That's what the crossover makes visible. Money isn't just money, it's future time. Most people will earn millions over a lifetime and end up dependent anyway, because every dollar flows right back out. The crossover offers a different path. Not easy, but clear. Stay consistent. Let the math work. The lines will cross, and one random morning, you'll realize something changed forever. You don't work because you have to. You work because you choose to. If this helped you see money differently, subscribe. I'll see you in the next one.